If you don't know your property ratios, you are flying blind. Cash flow is just not always enough. Hi, I'm Michael from MDH Accountants. We help business owners just like you scale property portfolios without wrecking your finances. I'll break down with you the 3 most essential ratios that you need to track for your property business to avoid expensive mistakes. Number 1, gross rental. So this could be from 2 angles. Number 1, if you're looking to buy a property for the first time, a property investment is all about return on investment, and rent is going to have a massive part of that. So you need to make sure that the rent that you're expecting to receive from the property when you're buying it is what you actually do receive. Because who wants to actually have to achieve that rent going for a wardrobe into Narnia? It's going to mess up your investment calculation and you are going to feel like that you're going to be shortchanged. Now, with rental prices, sometimes they can go up, sometimes they go down. And that could be the street could be really bad. It could also be that the market conditions are making rental prices go up or potentially go down. We know in the current market, there's been a lot of reduction in stock, which has been rental prices have gone through the roof. But that doesn't always remain that way. Sometimes they can be cheaper. So make sure when you're understanding your property, you know exactly what the rental that you're going to get and if there's a chance that it can go down, because that's going to affect your future profitability and cash flows. Price to rent ratio, and that's a calculation of where you take your monthly rent, times that by 12 and divide it by your property purchase price. That's normally commonly known as a yield, and I think it's a good guide. It's not a win or a lose, because I think a true investment calculation should be on a discounted cash flow basis, and I normally do these over 5 years to make sure that I get a specific compound return. But when you're looking at rental yields, you'll be able to see how much income is and skin that you've got in the game. And let me give you an example. If you're investing in Surrey or Croydon or London, you are going to get a yield that's a lot lower because the property prices are a lot higher, rent aren't as big, but hopefully you should get capital value in the long term. If you compare that to some places in the north, like I invest in Sheffield, the rental yields up there are a lot higher, but what you tend to find is the capital growth could be quite cyclical because them property purchases are on an income basis. So when you're looking at the most basic return on your investment, look at this ratio. It's something to also keep an eye on as well, especially when your property price goes up or goes down, or your rental income goes up or goes down. It's a cool ratio. Number 3, LTV. LTV is where you take your mortgage and you divide it by the actual purchase price or the current value of your property. Really important to make sure that you don't fall into a massive trap or where you're overvaluing your properties, so you're getting your LTV wrong. Whenever you're looking at revaluing your properties, if you do this on your personal balance sheet, make sure that they're realistic. Make sure they're not racy, and make sure you are not counting chickens before they've hatched and the value does not exist. But when you buy a property, you will normally put down a 25% deposit. So if you're buying a property for nice round figures of 100 grand, you're going to be laying down a 25 grand deposit and a 75 grand mortgage. 75 grand divided by 100,000 is 75%, and that is your LTV. Now this, from a financial perspective, will see the risk, because hopefully what you'll have is your mortgage will either stay the same or go down, depending on whether you're on an interest only or a repayment mortgage, and your property value hopefully goes up. But let's be honest, sometimes they do go down. So what you're hoping is that property then increases to say like 150, so instead of having 25 grand's worth of equity, you've got 75 grand's worth of equity, and that means your LTV is then 50%. Winner, winner. So you've either got the opportunity to sell that property and get back everything, or that additional 50 grand that it's got up, you can then capitalise and get another 75% of that value, which you can then go down to buy another property. We all like buying properties with no money down. So when you're looking at your portfolio, which mortgage companies will look at as well when it gets to a certain size, is know your LTV, because that is the value that you've unlocked within your property portfolio, which is, let's be honest, why we're all doing it. I hope this video's really helped. But if you need some further help, why don't you just jump on a growth call with us? I'll put my link below. This will allow you to book an appointment directly in my diary. We'll just talk about your goals and also your growth plan, and I promise there'll be no pushy sales pitch. But if you're also looking on ways where you can actually make more money by saving tax, we've got a book that's just for you. Our book's called 75 Ways to Pay Less Tax, The link's below, it's completely free. How many of these can save you absolute thousands within your main business and or your property empire?